The time to do it, the time to plan, is when you don't need the plan. The time to make allocations and make decisions is when you're not forced to, because decisions that you're forced to make or that someone else makes on your behalf can ruin families.
Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on the journey from millions to billions. And we believe the key to scaling and compounding your wealth starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth in life so you give more or all of it away to help MVPs. I'm your host today, Brett Swarts, and every episode we're featuring some of the world's top entrepreneurs, millionaires, and billionaires where they share their secrets and wisdom with us. So again, we can scale and compound and make a big impact. I'm excited about our next guest. He is out of Vail, Colorado, and he is on a mission to help us to practice a better wealth path. We're going to be talking about some neat stuff today, including the monumental great wealth transfer that's going on. We're also going to be talking about the financial advisory industry. Gary brings 35 plus years of financial advisor, educator, and visionary, and really kind of redefining the financial advisor profession and so much more. Please welcome to the show with me, Gary Sinderbrand. Gary, how you doing?
Great, Brett. Thanks for having me. I appreciate the opportunity.
Absolutely. And for our listeners to get to know you for the first time, would you give us just a little bit more about your story and your current focus?
Sure. I started as a financial advisor. It was actually called a financial consultant back then. Even before that, an account executive at Merrill Lynch, hired at the age of 24. I was younger than the people they normally hired, had essentially no sales experience at all. And during my early years, I often thought maybe I was the only one that showed up and applied for the job. But I kept coming back, and they didn't tell me not to, but they didn't exactly invite me. And I learned early on that probably persistence was one of the things they were looking for. Started at a young age. First time out of the box, had no idea what I was doing. I was listening to the training people at Merrill Lynch who told me, get out there and sell things. Great. Had no clue what I was selling or who I was selling it to. Went through my first set of clients in about a year and a half, selling uncovered put and call options against the collateral the treasury bills would yield. Back then, interest rates were quite high, and I would basically come on to people saying I could turn their 15% treasury bill into a 25% treasury bill. That didn't work out so well. So that was book number one. Almost quit at the end of my first year, but I was fortunate enough to run into someone in senior management that essentially understood that I did have a strong desire to succeed and started to expose me to training that really helped me turn things around. Over the next several years, I was always kind of at the top of my class. I went through $1 million in production, which back then was substantial. In my sixth year, you split that productivity with the firm you work for, and worked my way through the crash in 87. And by 88 or 89, my business was scaling really nicely. I was able to bring clients on board, not from promising them unrealistic outcomes, but from listening to them and figuring out how I could best solve their problems. This was kind of at the front end of financial planning, at the front end of the industry shifting from commission-based business, where each time you would call a client and suggest a transaction, they always had to consider whether or not that transaction was in their best interest, your best interest, or it was in both of your best interest. I thought that was kind of a lousy way to give advice, so I started converting my practice to a fee-based business, where my goal, and I told clients up front, my goal was to charge them as much as I could. And they would be a little bit surprised by that, and I explained further, the only way that happens is for your assets to grow through stewardship, and you following my guidance, you bring more assets in, and I have a fixed percentage. If the assets go down and you leave, I make less. So we're really aligned on that. I also explained to them that I was further motivated because to build my book of business, I had never made cold calls. I didn't believe in them. I would tell clients and prospective clients, up front, that as they perceive greater value of what I'm able to provide, I'm going to come to them from time to time to ask for help in meeting other people like them that I can also help. And that kept a constant state of referrals headed my way. Uh, Built a substantial business. Sometime around the end of the 80s, early 90s, I was approached by senior management at Merrill Lynch who observed I wasn't doing all that much of what I was taught. But my results spoke for themselves, and they wanted to know if I might be able to share that with a few other colleagues. That led to a pilot training program I did with one other financial advisor who was like minded. And for the next 12 years, myself and another gentleman traveled the country and taught over 10,000 Merrill Lynch financial advisors how to convert their business from a transactional book servicing as many clients as possible to a book that was based on relationships and empathy and outcomes. And our timing was pretty good. We were well in demand, so I spent about 10 or 11 years, maybe more, a combination of managing my own book of business of households and teaching other financial advisors. I
Amazing,
enjoyed
Gary.
it a lot.
Yeah. By the way, this is so good. And thank you for that incredible background. And I love how you said, assets to grow through stewardship, right? Aligning on fees and asking for the referral, right? It's so important. It builds a great momentum within businesses and relationships that it's a partnership, right? Not just an advisor serving, right? But together partnering to help people create and preserve more wealth. And it's incredible. So for source of time though, let's dive right into the topic at hand, which I think the one that'd be great to talk about is focusing on, the great wealth transfer, right? As you mentioned in your blog, you posted here on LinkedIn, and this great wealth transfer, right? This, I've heard 84, I've heard 100 trillion, I've heard different numbers on that, but basically, roughly 80,000 baby boomers in the U.S. alone, 10,000 turning 65 every single day, and they've got a massive amount of wealth that's transferring in the next 15 years is what I think most would say at this point. And so talk about just the big challenges as it pertains to capital gains tax, Gary, as well as the stewardship of the wealth as it also pertains to estate tax. And I'm just kind of curious on your thoughts on that.
Well, I think that this generation and this wealth transfer is wholly unprepared. When I would go through and onboard a new client, one of the things that I would always cover was basically the status of their estate plan. And for the most part, it was something where maybe their brother-in-law, who's a real estate lawyer, wrote up a will 25 years ago when the estate might have been worth $500,000. And now their estate's worth $25 to $50 million or more. They really haven't updated it. And they're something they're always going to get around to. And I was, I would say, fairly proficient in getting them to commit to a particular date and time as to when that would occur, explaining that while no one wants to face this thing, it's kind of like life insurance. Ultimately, it's going to happen whether you like it or not. And if you want to give a bunch of money away to the government, that's going to be your call. But if there are charities out there that you wish to support, if there are ways you'd like to control and make sure you protect your children and their children as well, there are some things to do that can really successfully manage your tax burden. One of the major sources of business I would receive would be from attorneys that specialized in estate and tax planning, as well as business transactions. And I would refer two or three. They would refer back when they had the opportunity. And I was able to really push a lot of my wealth management clients into a position where they actually did take action. What I'm seeing now, and is worrisome, Brett, frankly. You talk about the wealth transfer that's going to occur from the baby boomers down to the inheriting generation. It is a fairly, I would say, significant trend that as these clients get older, these households get older, their appetite for professional advice goes up. At the same time, their appetite for paying a fee for that advice goes up. McKinsey just published a recent study talking about what the impact is going to be in the wealth management industry. And by conservative numbers, over the period of time you mentioned, there will be almost $15 trillion in assets transferring from the oversight of senior advisors to this next generation of advisors. The problem, as I see it, is the next generation of advisors are not ready. The major issue is they're coming into the business with no experience in building a book or being able to create an empathetic relationship with a household. They have limited time exposure to that household. There is an asymmetry in the aging of the household where you might have a 70-year-old individual who's got a 70-year-old advisor. Well, that advisor is retiring, selling their book back to their company for a substantial amount of money. And the junior advisor has little or no relationship and very little in common with the individual that's now responsible for the family's wealth. As a result, that individual, for the most part, I would say in over 50% of the cases, is going to go seek advice elsewhere. When the head of the household ultimately passes, the odds that their heirs will stay with the same advisor even if they're all in place is very low. Even if their advisor is still in place, 90% of the time, the heirs are going to go someplace else. So there's no one that can kind of put everything together in that primary role that can wrap up all of the accounts sitting in various spots, no matter where they are. That, plus we also deal with some of the challenges of aging and wealth transfer. If we have successful real estate investors, by way of example, that have always done well buying multifamily housing, and they're starting to be a little less sharp than they used to be, their likelihood of listening to external advice becomes more and more challenged. So the time to do it, time to plan, is when you don't need the plan. The time to make allocations and make decisions is when you're not forced to, because decisions that you're forced to make or that someone else makes on your behalf can ruin families. You can have children who recognize that the father or the kind of the matriarch or patriarch are no longer in possession of their full faculties. And as a result, actions aren't taken and dramatic declination of wealth can occur. So I think it's twofold. I think there's a shortage of good professional advice out there. It's going to get worse as the population ages. And I think the tax treatment on a lot of estates that come through, depending on what happens with, obviously with tax law and estate planning, is going to be problematic. The greatest, and I'll pause after this, but the greatest potential problem that I've experienced, and I see that coming forward, is an individual with a large estate, primarily in illiquid assets. Well, the government doesn't really care if they're liquid or illiquid. When you owe the money, you owe the money, and if there's not enough cash to pay for it, you're going to end up, or the heirs are going to end up selling it at numbers far below what it should be worth. There's so many different strategies to avoid that taxation. But again, you need someone in that primary financial advisory role that can say, listen, we should go to this person or that person, and let's get this set up the right way now.
This is so good. Gary Sinderbrand, everybody. I want you to go and check out betterpathtraining.com, betterstretching.com, especially if you're a financial advisor, right? He's a legend in the industry, as you could probably tell by now, the last 15, 20 minutes, of navigating complexities of the financial advising career and strategic guidance. And he has a passion for this wealth transfer and what it's going to mean, and how to be a great steward and help your clients be a great steward. It's betterpathtraining.com. So I'm going to a couple of things I want to highlight, and then I think I want to get a little tactical with you here, right? So I thought you said this is great, right? They're wholly underprepared. The status of their estate plan is probably outdated, right? The key is to set specific dates and times where they're actually going to do the plan, right? It's a lot of times they don't want to think about it. Even speaking and working with estate planning attorneys, CPAs, business exit planning, is so important. And then you mentioned a couple things, the ability to create an empathetic relationship. It's really difficult when they haven't had the decades of that relationship with these clients, and you're right. And so just to step in, you just can't replace experience. And then you coupled that with the declining health. I know my dad's going through it with his early stage dementia, and seeing that, and he's still fully there. He's still present, but his mind is, he can tell that his memory is fading, right? And it's spotty. And it's obviously a big challenge, right? And then you have this, I think the wisdom that was really, really pertinent here is you need time to plan, and the best time to negotiate or plan or anything is when you don't need to negotiate or you don't need to plan, because you're just, it's a calm part of your life. The opposite is tough. Decisions that or when you're forced to make under the gun, right? Or under stress or under health challenges. And, that's the worst time. And that can ruin families. That can just literally devastate families and the legacy you've built for so long, right? Because you put yourself under a forced decision. Did I miss anything there, Gary? Did I pretty much get it on the head?
No, I think you captured all of it. The one comment I would make from the perspective of empathy, empathy and an advisor's ability to invest their time in educating the client with baseline agnostic principles was really something I relied on all the time. My feeling was I was dealing primarily with people that were successful. They were smart. They may not have been smart in the business I was in, but that didn't mean that I couldn't lay out enough of the building blocks for them to be able to determine their own decisions. At the same time, if you're an advisor and you don't have trusted advisors that you can refer to on a regular basis, you're really leaving a lot to chance. I knew with the 2 or 3 estate planning attorneys I would refer to, I knew what they were going to do. I knew how it was going to work. And I spent a lot of time vetting those people to making certain that if I gave those names out, A, they do the right thing, and B, it wouldn't come back and hurt me in any way. So I think that for the advisors out there, A, if you have a client you value, you need to call them up when there's essentially nothing to discuss other than to let them know you're thinking about them. That will build amazing relationships over time because you go through their life with them. And the second thing is that you really have to be available for them to call you and ask you any question just for an opinion. Most of my clients became very good friends that I dealt with. And as their kids got older, there wasn't a question as to where the money was going to go. It stayed. And again, because I was able to make certain suggestions. You had mentioned one thing earlier regarding handling of capital gains. A lot of my work now is focused on counseling what I call vertical teams, very successful senior advisors who are mentoring junior advisors. And I help train the junior advisors while I'm aligning the senior advisors to move the book downhill. In one case, and this was before this market entered whatever historians will eventually call it. I think that's going to be up for grabs. But NVIDIA was trading near an all-time high, and one of my clients had an investor that purchased, I think they put something like $25,000 into NVIDIA some time ago. It was worth $6 million. So it's not worth that right now, but that's what it was worth. The advisor didn't have anything to do with it. It's an extraordinarily low cost basis. So the suggestion I made was I asked the advisor, how many grandchildren does this 80-year-old client have? And the answer was 14. Well, all 14 of them several months ago received a significant gift of NVIDIA shares. And from the perspective of utilizing some of that unified gift and estate tax credit, it was fairly smart to do because the client didn't need the money. They had plenty. But just to think about something like that, and now this younger advisor has 14 brand new relationships that will always credit that individual for changing their financial pathway.
Absolutely love it. And it brings me to a thought I've been studying, and it's Charlie Munger and Warren Buffett, right? And one of the things that Charlie's, I think, famous for, or he talks about a story of how he became, I think, a wise investor and a prudent steward of capital, is he would look at things on the inverse. And so he talks about the story where he used to be like an aircraft carrier during the war, helping planes to land properly, right? Safely. And he said he came into it, he didn't have a lot of experience and he didn't really know a lot of training. And he's put in this position. He's like, I'm not sure what to do, but he remembers like thinking through it and going, how about I inverse the problem? And I say, look, what would I do if I wanted to kill all of the pilots, right? If I wanted all of them to crash and die, right? What would I do, right? And he came up with 2 conclusions. Number one, I'd make sure they didn't have enough fuel. And so they couldn't return to the plane, the aircraft carrier in time, and they would crash and they'd die. And number two, I'd put them in positions where their wings and the way the plane flies, the altitudes would rapidly change, and they'd also crash. And he goes, if I wanted to kill them, that's what I would do. So then he thought about it. Well, how about we eliminate those two things, right? So then he inverted it one more time. Okay, so now I'm going to always, number one thing we're going to do is always make sure they have enough fuel to return to the aircraft carriers. Number one, that's our number one thing. Number two, don't put them in positions where they're going to be flying and it could alter, their height or whatever too quickly and they crash. So these are the two things. And so he started to apply that to Costco and different investments and different theses, right? And that's kind of how he, part of their secret sauce of how they built, what they've built. But I thought this is interesting, Gary, like what we're talking about here. The next question to ask ourselves as we're applying everything we're talking about today is, if I wanted to squander my wealth and everything I've built up in my life with the finances, what would I do, right? And one, I wouldn't have an estate plan, or I wouldn't even have a living trust, or I wouldn't update it. It'd been so many years ago. Number two, I wouldn't assess what is my current net worth and how much is inside of my taxable estate, right? I just wouldn't even think about that, or I just think that the stepped up basis is going to solve that. Number three, I wouldn't care about illiquidity, right? Because what's it really matter? I'm just going to die, and the kids, the heirs would figure it out anyways, right? And we have such a big estate. That wouldn't really something I would think about. And in other words, I would let the complexity of all of it, I would let that just overwhelm me, or just make me dismiss it because I have so much wealth. Number two, I let the comfort of just having so much wealth just maybe kind of lull me to sleep a little bit here, right? And number four, I would become just complacent. And if I wanted to squander all of it, that would be my mindset: complexity, comfort, complacency. And I just kind of let it, figure it out and just keep living my life, right? If I wanted to squander my wealth, right? Anything else that you would add to that list, or what do you think, Gary?
No, I think that you're clearly on the right pathway with this. The issue that most people run into, Brett, is these are not things they want to think about. They've got their own world, their own life, they've got their own obligations. And again, it's just something we really choose to avoid as individuals. No one wants to contemplate what happens when we're not here. I think what this does, and the trends are clearly showing it, especially in the most recent McKinsey study, that there is a growing desire for professional advice. And the position I always wanted to hold was that of the primary financial advisor. I needed to see everything. I didn't get paid on everything, but the fees I earned were more than sufficient to compensate me for taking a very large, elevated view of everything. And if insurance was needed, even though our firm sold insurance, I had no interest in it, I would refer that out. If a mortgage was needed, I'd probably refer that out. Estate planning was needed, accounting was needed, I would refer that out. All of those relationships came back to my benefit, but the reality was that you can't expect a typical high net worth investor to have at their disposal all of these different elements that have been pre-vetted and also that they can count on. Now, when you get into the ultra high net worth category and there's a family office around, it can change a little bit, but you still need someone that's on the outside that knows where everything is, knows how things are going to operate. And God forbid, if someone passes away after the family's notified and things settle down, the advisor steps in and can really help move things in the proper direction as efficiently as possible.
Awesome.
That's where the advisor really makes their
fantastic. So let's get practical. That's beautiful. I love the way you put that, and I love the way that it's like a family office type of approach that it's multi-generational to help with this process, right? And the mindset is have a dream team, have a core team, have the experts that vet the other parts of the team that help to build this out and kind of quarterback it, or offensive coordinated it, right? I love it. So let's get tactical. So part of what we do, Gary, is we help people eliminate estate tax and also defer capital gains tax. Quickly, my story: I started at Marcus and Millichap, and I saw friends, family, clients was half or all their wealth because they had illiquid apartment complexes, too much debt, not enough liquidity, and the market crashed, and they were stuck doing this 1031 exchange, I call it the shotgun wedding, right? Where they're just always levering up and even taking on more debt typically. And then the music stops, and we're seeing it actually happen again right now for people who overpaid for commercial real estate a couple of years ago, and it's all coming back. And the big thing we found is if you don't have enough liquidity diversification, or an intentional plan with the team in place, you can get over your skis and you can lose it all. And so we learned about a strategy that eliminates the need for the 1031 exchange, and it gives liquidity diversification. You can input it with a financial advisor, and you can diversify it. You can also go back into real estate, but you can do it at your own timing. You don't have to force any kind of 45 180 kind of thing. And so we call it, it's known as a deferred sales trust. Some people get confused with the Delaware statutory trust, right? It's a trust with the third party trustee. That's our role. And so we set these things up. And so I met the tax attorney years ago, and like most people, we thought we had all the answers, right? We thought the 1031 exchange was the end all be all, but we were also incentivized to do the 1031 because we get paid again and again. That's how we got paid. And so it wasn't necessarily aligned. Only if the deal really worked out was it aligned. And so once we learned about this new strategy that we could do it in a way that has been through all the audits. It's got decades of track record. It's of tried and true tax law, all of it. And we jumped on and said, this is the Netflix of the old Blockbuster. Like, we won't put people in this position ever again. And it works for businesses, Bitcoin, stock sales, primary homes. But I'm curious, like, you've been in the industry a long time. I'm wondering, A, have you heard of this one before? And then B, when you're vetting a new tax strategy, right? Or when you were vetting these tax attorneys, like, how did you know, or what questions would you ask that would help to be a great steward of the relationship to hand over to that tax attorney with this big estate tax plan or capital gains tax exit plan? Help us with that, Gary.
So I wanted a number of different things, and I know the strategies have changed, but mutually defective AB trusts, husband and wife trusts that basically would turn into testamentary trusts upon passing, using, I think it was 2303C or 2503C for somewhat intelligent way to move money from the trust down to the kids. The strategy you just described, I'm not familiar with. It sounded a little bit like an ESOP transaction, where you can also get that deferral and recover most of the wealth. But in ESOPs, you've got to have that cash flow that can basically retire the note. So it is a strategy I'd like to learn more about. I always looked at it from the perspective of looking at what the desired outcome was. And then I would be wide open to any solutions that were available. There were a number of things, and the attorneys I worked with were always great educators. I would always be able to get them on a quick call and say, what about this or what about that? And that's how I'd learn. So I did interact with them a lot. I never assumed them to be a threat in any way, shape, or form. They were there as being able to be an adjunct and to enhance the relationship that I had. The strategy that you mentioned, I am unfamiliar with it. I would like to get more familiar with it because I'm talking to advisors all the time who are always looking for something different that they can do.
Yeah.
So I would love to follow up with you on that and learn more about it.
I love it, Gary. By the way, I love the way you put that, right? Start with the desired outcome. I think one of the biggest things, even the seasoned financial advisors or senior, business broker, M&A advisor, real estate broker, whatever profession when you're serving, even CPAs, you're serving the client, right? Too often the fundamentals is we don't stop and say, hey, before we talk about tactical, like, what do you want? And not just what do you want, like, what matters to you the most, right? Like that next layer of question, like, yeah, there's probably like 10 or 20 things that matter to you, but what matters to you the most? And by the way, what matters to your spouse the most? And then what matters collectively for your legacy moving on the most, right? And let's rank that, and let's focus on at least those 1, 2, or 3 that are the top. And let's find out if we can find the other pebbles to roll in. But those big rocks, we got to get those right first, right? And trying to simplify it, and then saying, okay, based upon what that matters to you the most, now let's look at the tactical. And maybe it's a couple. Maybe it is a partial of a donor advised fund and a partial charitable remainder trust. And maybe it's a partial 1031 exchange, but maybe it's also a deferred sales trust. Maybe it's a partial ESOP. Maybe it's a couple of these depending on what qualifies, right? Because certain strategies don't qualify. Like a 1031 exchange, you can't qualify for anything but invest in real estate, right? Ours, it can work for any asset of any kind. And when you do that, it actually helps to clarify the outcome of where you want to go, obviously. And then B, helps us speed along and basically declutter the complexity, right? Which if you can declutter the complexity, then you could just execute the plan. So any other thoughts on that mindset of this, Gary? Because I think this is a big piece of it that I think people miss, and they run out of time. They're at 30 days to close, it's a $10 million exit, and their CPAs, I've never heard of it, right? And then there's other financial advisors like, I've never heard of it. And then they're like, well, I don't know what to do. I'm just going to pay the tax, right? And they end up, get caught because they don't plan. This is sometimes what we do. Now, when we have more time with them, we close in 9 out of 10. Like it's a very, very high close ratio. But I'm just curious, like any other mindset or thoughts on that?
I think you really kind of captured the way I would look at it. Was almost identical. I think about it that you need to meet that client where they are, not where you want them to be, and let them articulate in their language, this is what I want it to look like when it's all said and done. And from that point forward, they've kind of sold themselves, if you will, because they give you a set of parameters, a set of circumstances, a set of outcomes, and you say, based on everything you've told me, here's how we can get you from here to there. Now, you may not understand all of it. We may have to bring in some external help to do it, but everything you've told me can satisfy where you are now and how you've articulated where you want to be in the future. So I don't look at it from the investor standpoint to try and have all the solutions. As the advisor, my job was to try and be as aware as I could of all of the solution, what the solution set would be, from how I'd position the assets. And clients would say, what are you going to buy and what are you going to sell? My response would be, I have no idea. I need to figure out where you want to go, figure out what we're doing right now, and then make those lines connect using some conservative assumptions and some baseline math. Then I can come back to you and say, okay, here's how the assets have to be positioned. Here are the individual things we need to do. But by the end of it, they just wanted to know that I knew, which I think is the job of any advisor. It's not to educate the client to take your job. It's to get them to the position where they have trust that you actually know what you're talking about.
And on top of that, not that you knew, but that you cared enough to slow them down and yourself down from just, saying the thing that you've probably done let's say 1,000, consultations over the years, and you probably knew it was probably going to be this one, but you also knew that if you didn't help them discover it for themselves, they wouldn't, own the responsibility or own the stewardship or be a part of it. They're not, basically giving up the responsibility. And that to me is just as important, right? That you care enough to empower the high net worth individual, the person who's exiting. And of course, they need the guide, they need the help, and they're going to lean on you for the expertise. But this is where it becomes this, you call it coaching, call it mentoring, call it mindset, call it, I think financial advisors can be a number of different things for different clients at different times. It's a beautiful profession in that scenario, right? Where you're helping these individuals become great stewards with the capital. So we have a saying, we exist to unlock capital gains to multiply freedom and impact. And it starts with freedom and impact for the family individually, but also starts with freedom and impact to bless, even themselves, not just with the wealth, but more of themselves to be able to give to their families or to their community or whatever that next chapter is in life. And then also to bless MVPs, the most vulnerable people. And so what does it mean for you? Okay, so you're all taken care of, like you're on the island, everything's going great. Okay, what's the next most important thing to you for making a difference in the world that's meaningful for you, right? What breaks your heart, right? What's going to make a lasting impact for generations? If you can help that person, that group, what is it for you? Like, the environment, like whatever that is, right? Whatever you're passionate about. So I agree with you, and I would just add the care part, just knowing that you care.
Well said.
Cool. That being said, we're running out of time. You ready for the lightning round?
Sure, fire away.
All right. Knowing what you know now, if you can go back to your 25-year-old self as a financial advisor, what's the one core thing you make sure to tell yourself to do?
I would have been much more focused on identifying the archetype of client that I would fit with. It took me a few years to get that under control. I went through some areas where I had to advise my clients to seek advice elsewhere. Mm-hmm. But there were certain clients I vibed with and certain clients I didn't. And I would be a little bit more definitive as to what I would do.
Love that. We call that elves versus haves, right? Easygoing and loving and fun versus hard, annoying, lame, and frustrating, right? And so, we always make sure we're not hard, annoying, or lame or frustrating. That's the first thing. We're easygoing, loving, fun. Number two, we expect that too of our clients that we're going to serve, right? That we're easygoing, loving, and fun. We're going to solve these things together. So I couldn't agree with you more. That's really great. So clarifying the client avatar and making sure you're setting clear boundaries to say no up front sooner. Okay, good. Question number two, number one book you've recommended or gifted the most in the past year?
I am kind of a science fiction geek, fantasy literature, primarily anything by Craig Allenson. He's got a series of 19 books. I think the 18th or 19th is coming out next month around Expeditionary Force. It just allows your brain to release from everything. And you get into these various characters. And I find that if I can kind of send my mental faculties out for a brief vacation from time to time, I'm able to come back, and the problems I couldn't solve or the things that I couldn't come up with a ready solution for when I come back into the real world seem a bit easier to manage. So I
Love
like
it.
letting it go in that way.
Good. Awesome. Question number three. What are you most curious about right now?
I'm a big believer in Occam's razor. And as this, whatever you want to call the current administration, and I don't think it's red versus blue, I think it's sanity versus insanity. But I look at it from the perspective of there's so many explanations for what is currently going on in our country and ultimately globally. What's the most simplistic explanation? Because that's usually the correct one. Multiple paths to the same answer. Find the one that's got the least numbers involved. And I look at what's going on currently, and I don't want to be, I would say, what's the word I'm looking for? Overly depressed by it, but the whole thing to me feels like a giant grift. And if you are going to find a way to make as much money as possible in as short a time frame as possible, what would you do to the markets? What would you do to the public in general, assuming that you absolutely lacked empathy at an institutional level, which I think our current president does? What would you do? And it just starts to check every box. So am I paranoid to think that most of his cabinet administration has been short the market since Election Day? Maybe. But again, the simplest explanation is usually the one I go to. So I worry about where this is going to come out, because I don't think the people making decisions really understand the interconnectivity and the complexity and what I would call the perturbations that are just going to run down the line, and how these things will profuse. There's no single decision that's being made today that's not going to have an impact tomorrow, next week, next year, or next month, or whenever it might be. So I'm concerned about that, and I don't know quite where it comes out. I try and read as much as I can from both sides, but I just can't make sense of it. What I used to tell my clients, and I tell my advisors now, is I got paid to read the stuff to figure out the stuff that wasn't published. What was missing? Because if everybody has an opinion in one direction that the markets are only going to go up from here, to me that kind of indicates that everybody's already made a decision. So who's left to take them higher? The same thing happens the other way. So I try and look at how these larger sentiment or emotional issues or biases, if you will, impact decision making. But over the past 60 to 90 days, a lot of the metrics that I always looked at are they're unclear. And I think the messages that are filtering down to the public in general in this 24-hour algorithmically driven news cycle primarily are going to cause people to withdraw, keep their hands in their pockets. And despite the claims of whatever the hell this current economic policy is doing, when people are scared, they don't act, they don't spend. And you can bring on a recession primarily from just the psychological belief that tomorrow is not going to be as good as today. So that's got me thinking quite a bit.
Yeah, that's hot. Thank you for sharing. That was very insightful, and obviously you've given that a lot of thought, and I appreciate that perspective. So we're completely out of time. So first, I want to thank you for being on the show, Gary. This has been insightful. It's been fun. It's been engaging, and it's got us thinking, which I think is really the good thing here to take some action. I want to encourage you to keep using your strong desire to succeed, and also a strong desire to listen and bring the best solutions to your clients to help them be great stewards with their wealth, and the financial advisors that you're really you're serving, right? Because that's where you're serving now, to help them to help their clients steward. For our listeners who want to get in touch with you, could you remind them one last time what's the best place for them to find you?
Sure. They can find me on my website at Better Path Training, all one word, betterpathtraining.com. They can also access a podcast over the next few weeks I'm about to launch titled If the Public Only Knew, which is kind of telling the story from both sides of the desk, what you should know and when you engage an advisor, and if you're an advisor, what you should be thinking about when you're talking to that client. They can find me there, or first name Gary.Sinderbrand@gmail.com.
Awesome.
Or
Thanks,
LinkedIn.
Gary. Perfect. Thank you so much, Gary. I also want to thank all of our listeners for listening to another episode of the Build It to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels as well. And we're here on this journey to scale from millions to billions so we can give more, all of it away to help MVPs. And we're learning from amazing guests like Gary on how to be great stewards with the wealth, how to think about things in a way that is going to encourage proactive planning and also intentionality and empathy. And so Gary brought the wisdom today. I encourage you to share this with someone it can encourage and impact today. And of course, if you have a massive exit coming up, $1 million or better in gain and in proceeds, go to capitalgainstaxsolutions.com. That includes business, sales, real estate. We have the best 1031 exit plan that we just released that gives you an alternative to an exit plan or a regular 1031 exchange in case you want to try that and not have to be forced into a 45-180 tight window. So just go to capitalgainstaxsolutions.com. Appreciate everyone listening or watching out there, and we'll talk to you again real soon. Bye now.